This is Professor Nilesh Shah from JK Shah Classes, and today we are going to discuss the RTP for Advanced Accountancy CA Inter November 22. Advanced Accountancy Paper 5, remember. Practical questions we are going to discuss, remember. First is on dissolution of firm, partnership, dissolution chapter. In case of partnership, there are 4 parts. One is dissolution, one is piecemeal, one is conversion, and one is amalgamation of firms, remember. This question is based on piecemeal distribution. See the first question. The partners P, Q and R have called you to assist them in winding up the affairs of their partnership. Winding up the affairs is basically nothing but dissolution. Their balance sheet as on that date is given below. Firm's balance sheet is given. On the liabilities side, you have capitals of the 3 partners and creditors. There's only one external liability, and that too unsecured, remember. On the asset side, you have land and building, plant and machinery, furniture, stock, debtors, cash at bank, loan to P, loan to Q, that is to the partners, and then total. The partners share profits and losses in the ratio of 4:3:2. Cash is distributed to the partners at the end of each month, remember. A summary of liquidation transactions are as follows. First month, January. They have collected 9,000 rupees from debtors and 8,000 rupees is received from the sale of entire furniture. Please don't calculate whether you have made a profit or loss on realization of assets. It is never to be recorded in piecemeal distribution. 1,000 were liquidation expenses paid and cash retained in the business at the end of the month is 6,000. So 6,000 is the balance to be carried forward on 31st January. Total cash available should not be paid off. In February, 1,000 liquidation expenses were paid. As part payment of his capital, R accepted a machinery for rupees 9 lakhs whose book value was 3,500. 2,000 cash retained in the business at the end of the month, remember. In March, 38,000 is received from the sale of remaining plant and machinery. 10,000 is received from the sale of the entire stock. 1,700 were liquidation expenses. 41,000 is received on the sale of land and building. No cash is retained in the business. So March month is the last month. Total dissolution ends over there. You are required to prepare a schedule of cash payment among the partner by highest relative capital method, also known as surplus capital method, remember. Also known as excess capital method, also known as proportionate capital method. Same method, 4 names, remember. It's piecemeal distribution. It's a statement. You don't have to prepare realization account, partners, capital account and so on. No. It's a statement in a columnar form. So just see the solution. Particulars column, cash column, creditors columns of 3 partners P, Q and R. Balance due after loan. So loan is adjusted. If you see the question on the asset side, loans were given to 2 partners P and Q. So amount is receivable from them, 13,700. 7,000. What will P and Q will say? Adjust it against the capital. Capital means firm has to pay the money to the partners. So it will be adjusted against the capital. P capital was 65,000. Loan was 13,000. So net figure is 52,000. Similarly Q, similarly R. Creditors was 16,000. Now balance available 9,000. From where do you get this? From the balance sheet. To this we add realization less expenses and cash retained. So how do you get this 10,000? It's simple. 9 plus 8, 17,000 minus expenses paid 1,000 minus cash retained carried forward 6,000. So what is the maximum cash that you can pay right now? 9 plus 8, 17 minus 1 minus 6, that is 10,000, which is considered over here. So total amount available is 19,000. You will first settle creditors, full 16,000. So 16,000 is paid to creditors. Once you pay 16,000 to creditors, all external liabilities are paid off. Now there are no internal liabilities like partner's loan given to a partner on the liabilities side, remember. So now what you are supposed to pay next is your capitals of the three partners, remember. But highest relative capital method. So whom are we supposed to pay first? That is what you are supposed to find out in a separate working. See the working for highest relative capital. This is the capitals after adjustment of loan. Next information that you record is your profit sharing ratio given in the question. 4:3:2, remember. Third step is divide your capital balance with the PSR. So 52,000 divided by 4 is 13,000. In short, P has contributed for every share of profit 13,000 as capital. Similarly, Q has contributed 14,500 per share of profit as his capital contribution, and R has contributed 16,000 per share of profit as his share of capital contribution. Find out which is the least, 13,000, 14,500 or 16,000. Whichever is less is taken as a base. So P's contribution per share is the least, 13,000. That you take it as a base, that you multiplied with the individual PSR. So 13,000 into 4 gives you 52,000. 13,000 into 3 gives you 39,000. And 13,000 into 2 will give you 26,000. Now A minus this. So now it will become 0. 43,500 minus 39,000 is 4,500. 32 minus 26 gives me 6,000. So Q and R have contributed excess capital, surplus capital as compared to P's contribution, remember. Now find out between Q and R who has contributed surplus capital. Same procedure. Find out the PSR of Q and R, 3:2. Divide this balance with the PSR, 1,500 per share, 3,000 per share. So who has contributed less per share? Q. Take him as the base. So 1,500 into 3 is 4,500. 1,500 into 2 is 3,000. 6,000 minus 3,000, you get an excess of 3,000. So you should first pay 3,000 only to R. After you have paid 3,000 to R, next in line will be, you will pay Q 4,500 and R 3,000. And after you have paid them, then the third order of payment will be 52, 39 and 26,000, remember. Over here, how much cash we were having extra? 19 minus 6 paid to 16 paid to creditors is 3,000. Full 3,000 is given to R. So your first order of payment is done. 3,000 were to be paid to R. You have paid 3,000 to R. Your balance thereafter, 52, 43, 29. February. Liquidation expenses paid 1,000 and 2,000 is to be carried forward to the next month. Which means how much cash you were having opening? 6,000. Out of that, 1,000 expenses gone. 2,000 is to be carried forward. That means you can't pay that money to anybody. So right now, in the month of February, you can pay only 3,000. That's the amount available for distribution. If nothing else was given, this 3,000 I would have divided between these two parties, Q and R, in the ratio of 3:2. However, there is some extra information. As part payment of his capital, R accepted a machinery for rupees 9,000. This is your agreed value, whose book value was 3,500. This is totally irrelevant. So 3,500 taken over for 9,000, firm has made a profit. Don't think about that. It automatically gets adjusted. What is important is R is taking over a machinery at an agreed value of 9,000. So it is as good as the firm has repaid back 9,000 rupees to R, remember. So over here, R 9,000 machinery given. But as per the second order of payment, to R we were supposed to pay only 3,000. But we have given him a machinery of rupees 9,000. And how much cash we were having? 3,000. So full 3,000 will be given only to Q. Not a single rupee will be paid to R. Because instead of cash, to R we are giving them a machinery, remember. So full 3,000 you give it to Q. After that, you have the balances. Remember, R we were supposed to pay only 3,000, but the firm has given him an asset of 9,000. Excess amount was paid at that point of time. Now comes March. Opening balance 2,000. How do we get 87,300? Received on sale of remaining plant is 38,000. So first check on the calci, 38,000 plus 10,000 received from sale of entire stock. 41,000 is received on sale of building, and minus expenses 1,700. So how much do we have? 87,300 now. So total cash available is 89,300, remember. And this is the last month. Nothing is to be carried forward. So now this 89,300 has to be divided between the partners. Whom, how much are we supposed to pay? That is what you are supposed to now calculate, remember. Okay. P, Q, R. Second order was Q you were supposed to pay 4,500. R you are supposed to pay 3,000 rupees, remember. First order. So third order will now be 52, 39, 26. 52, 39, 26. In February, machinery is given to R of agreed value of 9,000. Now how do we proceed over here, remember? March. Cash available is 89,300. Over here, cash was paid to Q of 3,000 in February now. Now, 9,000 was to be paid to R, 3,000 was to be paid to R, against which we gave him a machine of 9,000. 4,500 was to be paid to Q, against which we already paid him 3,000. So first what you should do is, out of this 89,300, you will first give only to Q 1,500. The moment you pay 1,500 rupees to Q, can I say my second order is done? Out of this 26,000, machinery was given of rupees 6,000. So how you got 6,000? 9,000 was the value of machinery given to R in the month of February, second order, when we were supposed to give only 3,000 rupees to R. So we have given him extra amount. And what is the PSR? It's 4 is to 3 is to 2. So for 2 share, we have already given him PQR 432. For 2 share, we have already given him 6,000 in the form of machinery now. So proportionate amount should be paid to P and Q in the form of cash. 3 share it will be how much? 9,000. 4 share it will be how much? It will be 12,000. This amount has to be paid in cash to P and Q only, remember. We have given to Mr. R out of 26,000, 6,000 in the form of machinery. This 3,000 was in the form of machinery. 9,000 worth of machinery is given. So in the last order, out of 26,000, we have already paid him 6,000 rupees, remember. But in the form of machinery. So proportionate share of P and Q should be paid in cash first, so that their capitals come back in their PSR, remember. So for 2 share it is 6,000. For 3 it will be how much? 9,000. 4 it will be how much? 12,000. 12 plus 9 is 21,000. Now what is the balance? And how do I get the balance? It is 89,300 minus 1,500 minus 21,000. That gives me. And this you will divide it between 3 peoples, P, Q and R. In which ratio? In their PSR. 4 is to 3 is to 2. So P gets 29,689. 22,667 and 14,844. So P will get in all how much? 12,000 plus 29,689. Q will get how much? 1,500 plus 9,000 plus 22,667, and R gets only 14,844. Now use the calci. 12,000 plus 29,689 gives me 41,689. 1,500 plus 9,000 plus 22,667. That's 33,167. Add up the 3 figures just for cross verification. $89, 41,689, $32,767. There's some 66,800 divided by 9. It's 22,267. 22,267. So this is 32,767. See, 32,767 and 14,844. paid this much cash to the partners and their account is settled. They have not received the total amount. This is the loss which they will bear. And if you check this particular loss, it will be exactly in their PSR of 4:3:2. This is how you distribute cash under piecemeal distribution of cash, dissolution of a firm. That was your first question. Second question is conversion. Again, partnership firm is converted into a company, remember. A and V sharing profits and losses equally, desired to convert their business into a limited company on 31st December 21, when their balance sheet stood as follows. Creditors, loan creditors, overdraft, reserve fund and capitals of the two partners, remember. On the asset side, you have sundry debtors, bills receivable, stock, patents, plant and machinery and land and building. The goodwill of the firm was to be valued at 2 years purchase of the profits of average of the previous 3 years. So very simple. 3 years profits will be given, added, divided by 3, multiplied by 2 will give you the goodwill of the firm. All assets and liabilities were taken over by the company. The loan creditor agreed to accept 7.5% redeemable preference shares in settlement of his credit claim. Loan creditor is 1,60,000. But who will issue the shares? Company, not the firm. Land and building and plant and machinery were to be valued at 4,96,000 respectively. Vendors were to be allotted equity shares. In short, PC is to be discharged only in the form of equity shares. No cash, no preference shares, no debentures. The past working results of the firm showed that they had made a profit of 120, 144 and 168 after setting aside 8,000 to reserve fund each year. So this is your profit after transfer to reserve fund. So before transfer to reserve fund, you add back 8,000 because goodwill has to be calculated on the profits earned before transferring to reserve fund, remember. You have to prepare the realization account, partners capital account in the books of the firm, assuming that all transactions are duly completed. First, let us see the working of calculation of goodwill. See, 3 years profits plus 24,000. Sir, how we got 24,000? 8,000 transferred to reserve fund into 3 years. Every year you have transferred it. Divided by 3, multiplied by 2. This is your goodwill. 3,04,000. And whenever goodwill is given or we calculate, PC will always be as per net asset method. Assets minus liabilities. So let's calculate PC now. Goodwill 304. Agreed values, remember. Land and building, plant and machinery. See, land and building 4 lakhs, plant and machinery 96,000. Debtors, bills receivable, stock and patents, revised value not given. So you will be accepting it at book values, remember. This is your total of assets. 3 liabilities taken over at book values. This is the total. So this is your PC 840, which will be discharged in the form of equity shares only, remember. Now you close the books of the firm. Very simple. First step is transfer all assets and liabilities at book value to respective accounts. Like all these 3 items will be transferred to your realization account at book value. Reserve fund you will distribute among the partners in PSR, partners capital account, and this goes to your capital account. See, capitals were 160 and 24,000 reserve you have distributed in PSR. You have transferred the 3 liabilities to your realization account. All assets will go where? realization. At what values? Book value. Land and building will be transferred at 240 and not 4 lakhs revised value. Similarly, plant and machinery at 64,000 and not 96. See, 64,000 plant and machinery, land and building 240. Remaining all assets at book values, remember. First step is over. Record and receive PC. PC is 840. Entry for recording PC will be purchasing company account debit to realization 840. And how did you receive this amount? Only in the form of equity shares. So equity shares in purchasing company to purchasing company accounts gets closed. Third step that we do is dispose of assets and liabilities not taken over. Everything is taken over, so that step doesn't come. Expenses not given. There's no partner's loan. Now you close. When you close realization, you're getting a profit of 496. PSR is equal 1:1. Transfer their share of profit to partner's capital. Distribute the shares received 8,40,000 among the partners in their PSR 1:1, which will also be the final claim ratio to 420, and the account tallies. That's how you close the books of the firm in case of a conversion. Firm is taken over by a company, remember. Third, accounting for ESOP now. Employee stock option plan. Mehta Limited grants 1500 stock options to its employees on 1st April 19 at rupees 50. This is what we call it as exercise price. This is the price that the employee will have to pay if he wants to subscribe the shares. The vesting period is 2.5 years. I'll write it as 2.5 years. The maximum exercise period is 1 year. Market price on the date is 80 rupees. Exercise price 50. Market price 80. Discount of 30, which you are calling it fair value per option. Also called as intrinsic value. Difference between the market price and the exercise price. All the options were exercised on 30th September. Everybody purchased the shares. Give the necessary journal entries if the face value of equity share is 10 per share. Now, first if you calculate the expenses. Per year, 1500 stock options into 30 rupees into 1 upon 2.5. 1500 into 30 divided by 2.5. So per year expenses will be 18,000. First year, second year. Third year only for 6 months. So can I say the amount will be only 9,000 rupees, remember. Which means first year 18, second year 18, third year 9,000. See, first year 18, employee compensation expense account debit to employee stock options outstanding account, and the same is transferred to P&L. Second year also 18, expense and transfer to P&L. Third year 9,000 transfer to P&L, 9,000. Everybody subscribe to the shares. So company will receive money 1500 into 50 rupees, remember, that is 75. They have passed a separate entries, you can merge it, remember. Employee stock option 45 debit to equity share capital, and the balance goes to securities premium, remember. Face value is 10. 80 rupees minus 10, 70 rupees is your premium in simple words, remember. That's your ESOP chapter. Simple question. Buyback. Next. Umesh Limited resolves to buy back 4 lakh of its fully paid equity shares of 10 each at rupees 22 per share. So the buyback is at a premium of 12 per share. This buyback is in compliance with the provisions of the Companies Act and does not exceed 25% of the company's paid up capital in the financial year. So it's within the limits. Conditions, they have cross-checked it, verified it. Yes, all conditions are fulfilled, you can say. And the 4 lakh shares that they want to buy back is within those conditions. For the purpose it issues 1 lakh 11% preference shares of 10 each at par. So 1 lakh shares into 10 will be 10 lakhs. But what was the reduction over here? 40 lakhs reduction will be there. Fresh issue is only of 10 lakhs. So by default, CRR has to be created. And CRR you will create of how much? 30 lakhs. 40 lakhs is the reduction in equity share capital. New fresh issue of preference shares is only 10 lakhs. So by default 30 lakhs extra reduction, and this will have to be made by creating CRR, remember. The company uses 16 lakhs of its balance in securities premium account apart from its adequate balance in general reserve. Adequate balance. Give journal entries. Fresh issue of preference shares, bank account debit to preference share capital 10 lakhs and then transferred. They have passed two separate entries, you can merge it. See, CRR is created of 30 lakhs. Capital is to be redeemed 40 lakhs, premium is 48 lakhs, 88 lakhs total amount payable. Paid, this you can merge it, remember. Securities premium 16 lakhs, general reserve 32, premium write-off you have to do 48 lakhs, remember. That was your buyback chapter. 5B, this is theory. L, M, N and O hold equity shares in the proportion of 30 is to 30 is to 20 is to 20. There are only 4 equity shareholders. 100% equity shares are held only by 4 shareholders in AB Limited, and X, Y, Z and K hold preference share capital in the proportion of 40, 30, 20, 10. So company has issued preference shares also, and these preference shares are also held only by 4 people. Equity and preference, both shares are issued and both the shares are held by 4 different individuals. You are required to identify the voting rights of the shareholders in case of resolution of winding of the company if the paid up capital is 80 lakhs and preference share capital is 40 lakhs, remember. Proportionate you have to find out. Now, 80 lakhs is your equity share capital, 40 lakhs is your preference share capital. So, total share capitals, this is 2/3, this is 1/3. Equity shareholders is 80 lakhs, preference shareholders 40 lakhs, total share capital 120 lakhs. 2/3 is equity, 1/3 is preference share capital. Now, this 2/3 is divided among the equity shareholders. 2/3 30%, 2/3 30%, 2/3 20%, 2/3 20%, and this is divided among preference shareholders 40, 30, 20, 10, and you get the ratio. This is the ratio in which the voting will be done in case of liquidation, remember. So that was your differential voting rights. Amalgamation of companies. Big chapter. The balance sheet of Truth Limited and Myth Limited as on 31st March 21 is given below. Myth Limited is to be amalgamated with Truth Limited. So this is your vendor company and Truth Limited will become your purchasing company. The amalgamation is to be carried out in the nature of purchase. Second is in the nature of merger, also called as pooling of interest method, which you don't have to follow. Clear instruction, purchase method. They have given us the balance sheet of both the companies before amalgamation. Shareholders fund, share capital, reserves and surplus, non-current liabilities and current liabilities. Assets, non-current assets, property, plant and equipment and investments. You have current assets. They have given us the breakup of current assets, non-current liabilities and so on. Truth Limited would issue 12% debentures to discharge the claim of the debenture holders of Myth Limited so as to maintain their present annual income. Remember, right now the debentures were carrying an interest of 14%, but purchasing company will issue them debentures with a lower rate of interest, that is 12%. Old, it was 14%, new, it is 12%. So now same amount of interest income has to be maintained, which means amalgamation chapter. Old, 14% debentures. Amount was 1,50,000. So interest was, calculate 14% of 1,50,000, that's 21,000. Purchasing company is going to issue 12% debentures. Interest income should remain same. So what is the value of debentures that you have to issue? 175. So debentures are issued of 175. Non-trade investments, which constitute 80% of their respective total investments, yielded income of 20% to Truth Limited and 15% to Myth Limited. So both of them are holding investments. Non-current investments are specifically given as 80%. This income is to be deducted from profits while computing average profit for the purpose of calculating goodwill. So while doing goodwill valuation, you will not consider the income from these investments, remember. Profit before tax of both the companies during the past 3 years were as follows. These are your PBT, profits before tax. 3 years profits are given. Goodwill is to be calculated on the basis of simple average of 3 years profit. Simple average, no weighted average. By using capitalization method, taking 18% as normal rate of return. Ignore taxation. Purchase consideration is to be discharged by Truth Limited on the basis of intrinsic value per share. So you have to do goodwill valuation, you have to find out the intrinsic value per share of both the companies, and on the basis of that, PC will be discharged. And then you have to prepare the balance sheet of Truth Limited after amalgamation. Balance sheet is very simple, you will simply add up the figures, remember. So first, let's do the goodwill valuation. Capital employed, very simple, amount invested in the business. And which values are you going to take? The book values, remember. So over here, assets as per balance sheet is 2275, but you will minus non-trade investments. Non-trade investments not required for the business, long-term in nature, remember. This is your assets, net assets. Less the liabilities, remember, you will get your capital employed. This is at book values, remember. Now, how do we calculate the tax profits for the same? 3 years profits are given to you. Add up the total. Simple average divided by 3, remember, less non-trading income. Here it is the rate given as 20% if you see. 20% to truth and 15% to myth. So 1,50,000's 20% gives you 30,000 and 15% of 80,000 gives you 12,000. Minus it. Investments are not considered in calculation of capital employed. So income on those investments should not be considered while calculating your profits, remember. So you get 693 and 216. This is your profits, remember. This has to be capitalized. So 693 you capitalize at 18%. So you find out the value to be invested. 3850 is the amount that should have been invested in the business. Whereas they have invested only in 1985. Their capital employed. So their goodwill is 1865. Second company's goodwill is 467, remember. This is how you get the goodwill value. Once you have the goodwill value, now you can find out the intrinsic value. Goodwill, other assets 2275 and 1145. While calculating intrinsic value, you have to consider even the investments. Intrinsic value is if the company closes down tomorrow, how much will the shareholders receive per share? So all assets and all liabilities should be considered while calculating your intrinsic value. If revised value is available, revised value, otherwise book value, remember. See, debentures, revised value. Trade payables, provision for tax, this is your net assets. Remember, this is your vendor company. Truth Limited is your purchasing company now. We have already discussed that. Myth is vendor company, Truth is purchasing company. So 12,55,000. So intrinsic value is 40 rupees and 31.375. Now figures are odd now. Please don't try to find out the exchange ratio. What you do is, how do I discharge the PC and what is the PC? This becomes my PC amount. Net assets of the vendor company taken over. This much amount the purchasing company has to pay. So 12,55,000 is the amount to be paid. And how will the purchasing company pay the amount? By issuing shares. Shares of purchasing company. What is the intrinsic value of one share? Divided by 40 rupees. And you will get the number of shares. See, 1255 divided by 40. 31375 shares. Purchasing company will issue 31,375 equity shares of rupees 10 each at rupees 40 to discharge the PC, remember. Based on this, you just have to prepare the balance sheet, remember. See, share capital 31,375 but of rupees 10 each, and see securities premium 31,375 shares into 30 rupees, remember. This general reserve and PNL will be only of purchasing company, Truth Limited. Myths, reserves and surplus doesn't appear in your amalgamated company's balance sheet. It is purchase method, it is not merger method, remember. And remaining assets and liabilities, you simply have to go on adding, remember, and you'll get the figures. What is important is, in reserves and surplus, you have one called as export profit reserve. This is one of your statutory reserve. It is your statutory reserve, remember. This reserve has to appear in the books of the purchasing company, remember. So it will be, see, amalgamation adjustment reserve account debit to statutory reserve account. Amalgamation adjustment account is adjusted in your reserves and surplus and you get the balance figure. Remaining all items you simply add it and you show it in the balance sheet. Remember, that was your amalgamation question. The next question is on the chapter internal reconstruction of company. Internal reconstruction is always done only by those companies which are loss making companies, which has an accumulated loss in their P&L. P&L will be having a debit balance. Profit making companies never go in for internal reconstruction. Planet Limited has decided to reconstruct the company since it has accumulated huge losses. The following is the balance sheet of the company as on 31st March before reconstruction. Share capital, reserves and surplus. It's a debit balance, negative balance. Long-term borrowings, trade payables, other liabilities, PP, current investments, inventories, trade receivables, cash and cash equivalent. And they're giving you the bifurcation of every note. Issued and paid up. 150 lakh equity shares of 10 each fully paid, and you also have 6 lakhs 8% preference shares of 100 each fully paid. Reserves and surplus, there is a debit balance in P&L. Then you have 6% debentures, director's loan as a part of long-term borrowings. Trade payables are nothing but your creditors, remember. Other liabilities is interest accrued and due on debentures. PPE includes freehold property and machinery. Current investments, investments in equity shares of some company. Finished goods, debtors and bank balance. The board of directors of the company decided upon the following scheme of reconstruction with the consent of the respective shareholders. Remember, preference shares are written down to rupees 75 each and equity shares to rupees 2 each. That's the new value. 100 rupees becomes 75 and 10 rupees becomes 2 rupees. Remember. So if you see the solution, see old capital of 100, new shares, preference shares of 75 and capital reduction. Number of shares will remain the same. Similarly, equity share capital 1500 becomes 300 and the balance goes to capital reduction. Preference shares dividend in arrears for 3 years to be waived by 2/3 and for the balance 1/3 equity shares of 2 each are to be allotted. What's the preference share capital? 8%. So now let's find out the arrears of preference dividend. Capital was 600. So 600 into 8% for how many years? 3 years. So total arrears is 144. 2/3 96 waived, no entry, and this will be 48, 1/3. How do we pay them? By issuing equity shares of rupees 2 each. Very simple entry. Capital reduction account debit to equity share capital 48. Remember. Debenture holders agreed to take one freehold property at its book value of 450 lakhs in part payment of their holding. Debenture holders amount was how much? 600. We have given them 450 worth of property. So you still have to pay them 150, remember. Balance debentures to remain as liability. Balance debentures will be 150. Interest accrued and due on debentures is to be paid in cash. Very simple. Accrued interest account debit to cash or bank. freehold properties to be valued at 550 lakhs, remaining freehold property. Now, if you see a balance sheet, out of 425, debenture holders have taken at 450. So, balance 450 is taken over. So, balance will be, can I say 375? Revised value is 550. So, can I say there is an appreciation of 175? Freehold property account debit to capital reduction 175. All investments are sold out for 425. Investments were how much? 300. Sold for 425. Profit of 125, that will go to capital reduction. See, property is gone. Accrued interest is settled in cash. Appreciation, investments, 125, profit goes to capital reduction. 70% of director's loan to be waived. See the director's loan. $450. 70% is waived, and for the balance, equity shares of 2 each will be allotted. 450, 70% is waived. This is 70%, and for the balance we are issuing equity shares. Director's loan is gone. 40% of trade receivables and 80% of inventories are to be written off. From where are you going to write it off? From your capital reduction. So, capital reduction account debit to trade receivables, capital reduction account debit to inventories. Company's contractual commitments amounting to 900 lakhs have been settled by paying. Settled means paid. By paying a penalty of 72 lakhs. This is a loss. Where are you going to adjust it? Against your capital reduction. So, capital reduction account debit to bank. You're supposed to pass journal entries for all the transactions. So, we have written off all these items, and then the balance in capital reduction goes to capital reserve and capital reduction account simple. Okay. So, that was your internal reconstruction, a simple chapter again. Liquidation of company. Next chapter, liquidation means closing down of a company, winding up of a company. Like dissolution of firm, this is liquidation. Debit and credit balances of Blossom Limited as on 31st December 21 were as follows. Instead of giving you the balance sheet, it's like they're giving you a trial balance, debit and credit balances. Debit balances are nothing but your assets, and these are nothing but your liabilities. Land and building, other fixed assets, inventory, trade receivables and P&L. 8,000 preference share capital, equity share capital, bank loan, debentures, interest outstanding on debentures and trade payables. The company went into liquidation on that date. Prepare liquidator's account. Liquidator's account is nothing but your liquidator's final statement of account. And this is prepared on the basis of actual figures after liquidation is completed, remember. After taking into following. Liquidation expenses 3,000, liquidator's remuneration is 10,000. Bank loan was secured by pledge of stock. So, what is given as a security? Stock. Stock was how much? 525. Loan is only 4 lakhs. Debentures and interest accrued thereon are secured by floating charge on all assets. This is always implied. Fixed assets were realized at book value and current assets 80% of book value. So, this full amount, this is 80% and this will also be 80%. What is 80% of 5 lakhs 25,000? That is the stock figure. It is 4 lakhs 20,000. So by selling stock, you are going to realize 420, which is given as a security to the bank loan. But bank loan is only 4 lakhs. So you can easily repay full bank loan. And even after paying the full bank loan, you will still have a surplus of 20,000 rupees, remember. See the solution. Liquidator's statement of account. Land and building, full amount. Other fixed assets, full amount. Inventory 420 less bank loans, a surplus of 20,000. Trade receivables 80%. Liquidation expenses, liquidators remuneration. Secured by floating charge, debentures and accrued interest, so 108. Trade payables 4 lakhs. Preference shareholders, balance amount, nothing is received by equity shareholders, remember. So that's your simple liquidators final statement of account. Next question is on NBFC, non-banking finance company, remember. XYZ Finance Limited is a non-banking finance company. The extract of its balance sheets are as follows. Equity and liabilities in that shareholders' funds, capital, reserve. Non-current liabilities, you have loans and deposits. Under assets, you have non-current assets, property, plant and equipment. Investments in subsidiaries, shares of subsidiaries, and in debentures of group companies. Current assets, you have cash and bank balance. You are required to compute the net owned funds. How do we get the net owned funds? It is gross owned funds minus excess of investments in subsidiaries over 10% of gross owned funds, remember. You have to find out as per the systematically important non-deposit taking company and deposit taking companies Reserve Bank Directions 2016. Calculation of net owned funds. Now first you find out what is your gross owned funds. And how do we find out your gross owned funds? Remember, equity capital 200 if you see. General reserve 600. So that's 800. Investments are made in subsidiaries 650. Whereas investments allowed should be only 10% of gross owned funds, which is of 800. But they have made an investments of 650. Allowed was 10%. Excess investments is 570. This is not considered as amount invested in the business. It's considered as amount invested outside the business. It's gone. So 800 minus 570 gives you your net owned funds. Investments in subsidiaries of shares and debentures are allowed, but only to the extent of 10%. You can make excess investments, but that excess investments will not be considered while calculating your net owned funds, remember. Very small chapter, NBFC. Now comes banking company. The following figures are extracted from the books of Top Bank Limited as on 31st March 22. Interest and discount received. First of all, what have they asked us to prepare is a P&L account. Only P&L, no balance sheet, remember. So interest and discount. P&L has only 4 schedules. 13, 14, 15, 16. 13 is interest earned. 14 is other incomes, 15 is interest expended, 16 is operating expenses. So looking at the items, you have to realize, is this an income? If yes, will it come in 13? Will it come in 14? Is it an expense? Yes. Will it come in 15? Will it come in 16? Interest and discount received will come in my schedule number 13, interest earned. But interest paid on deposits will come in schedule number 15. This will not appear anywhere. That's your capital goes in the balance sheet, not in the P&L. We have to prepare only P&L. Salaries and allowances 16, directors fees 16, rent taxes, postage, telegram 16. Statutory reserve fund doesn't appear anywhere. Commission, exchange and brokerage schedule number 14, other incomes, first item. Rent received, income, again 14. Profit on sale of investments, again 14. Depreciation on bank properties 16, operating expenses. Statutory expenses 16, preliminary expenses 16, auditors fees 16. The following further information is given. A customer to whom a sum of rupees 16 lakhs has been advanced has become insolvent, and it is expected only 40% can be recovered from his estate. Only 40 will be recovered. So can I say the balance 60 is irrecoverable as such? Make a provision for the same 60% of 16 lakhs. There were also other debts for which a provision of 2 lakhs 10,000 was found necessary by the auditors. All this will come in your provisions and contingencies. Rebate on bill discounted on 31st March 21 was 19,000 and 31st March 22 is 25,000. This is closing and this is opening. See your incomes first. Received. To this, what I am going to do is add opening minus closing rebate. Preliminary expenses are to be written off fully during the year. Treat it as other expenses, schedule number 16. Provide 9 lakhs for income tax and transfer 25% of profits to statutory reserve, and P&L opening balance was nil, no opening balance. So now let's look at the solution. See, interest refer working note. See, add opening rebate minus closing rebate gives you the net income for the year. That's your interest income. Other income, see schedule number 14, commission, profit, rent received. So that's your other incomes. So what you'll get is your total incomes. Other incomes, total incomes. Expenses, interest expanded, it's simple, no adjustments, so just write it as it is. Operating expenses, see the list. Salaries, rent, depreciation, directors fees, auditors fees, loss or statutory charges, postage and preliminary expenses. Accordingly, we will get your provisions and contingencies. How do you get this 960? See the question. 40% can be recovered, so 60% is provision. And calculate 16% of 16 lakhs, it will give you 916 lakhs into 60%. 210 is the additional provision. This is your provision for tax. Clearly given amount, you don't have to calculate. So current year's profit or loss is 552.8. No opening balance. Total remains same. Statutory reserve 25%. 25% of 552.8. That gives you 138 into 552.8. And balance carried to the balance sheet. That's your closing balance. Again, a very simple P&L. First, write down the whole format of P&L. Then prepare the necessary notes, schedule 13, 14, 15, 16 and so on, and working note as required, remember. Last, consolidated financial statement. Okay. Consolidated Financial Statements CFS, wherein there are two companies, holding and subsidiary. They will be giving you the stand-alone balance sheets of both the companies, holding and subsidiary stand-alone, their own individual balance sheets will be given. Your job is to merge the two balance sheet and prepare one balance sheet which we call it as consolidated balance sheet. Now see a question based on it. 31st March 22, they are giving you the balance sheet of H Limited and S Limited. Remember, it's 31st March 22, which means the accounting year is 21-22. It is from 1st April 21 to 31st March 22. Equity share capital authorized. Ignore. Irrelevant. Important is issued capital. 4,000 and 2,400 rupees are in thousands. I'm ignoring that. General Reserve P&L credit balance, trade payables, that's nothing but your creditors, and provision for taxation and other provisions. Plant and machinery, furniture and fittings, investments in equity shares of S Limited. Inventory, trade receivables, cash and bank balances, and sundry advances, debit balance. Following additional information is available. H Limited purchased 90,000 equity shares in S Limited on 1st April 21. 1st April 21, that is on the very first day of the year. Remember, at the top the balance sheet is given as on 31st March 22. So the year starts on 1st April 21. On that date, the following balances stood in the books of S Limited. General Reserve 1500 and P&L 633. They are giving you the opening balances, remember. On 14th July 21, in the current year, S Limited declared a dividend of 20% out of its pre-acquisition profits. Pre-acquisition profits means out of its opening P&L balance, you can say. H Limited credited the dividend received to its profit and loss account. This is a common error, remember. Dividend was received out of pre-acquisition profits. So it should have been credited to investment account. It is credited to profit and loss account. It's a capital receipt. It is treated as a revenue receipt. So now your job is to rectify the same. You'll reduce it from the P&L of H Limited holding company and you'll transfer it to your cost of control account. That is, means it will be adjusted against your investments figures, remember. This is important. On 1st November 21, in between the year na, between 1st April 21 and 31st March 22, S Limited subsidiary company issued 3 fully paid equity shares of 10 each for every 5 shares held as bonus shares out of pre-acquisition general reserve. This capital which is given is after bonus. Share capital is as on 31st March 22. This is after bonus, remember. Whereas shares were acquired on the very first day before bonus. How many shares they had acquired? 90,000. But remember that 90,000 is not out of the 2,400, remember. You have to be careful. This is after bonus. Shares were acquired before bonus, remember. So very simple. Before bonus, if you're having 5 shares, bonus is 3 shares. So after bonus, you will have in all 8 shares. Bonus ratio is given, remember, 3 fully paid shares for every 5 shares held. So now here it is 240,000 shares. After bonus, how do I get this? It is 2,400 divided by 10. So find out what is your bonus and what is your before bonus capital. Simple cross multiplication. Answer will be, this is 150,000 shares and this will be 90,000 shares now. Out of this 150, 90,000 shares are acquired by H Limited on 1st April 21. So can I say it becomes 60% stake? Don't compare 90 with 240, that will give you a wrong answer. Sir, it is less than 50%, so there is no consolidation, no holding subsidiary relationship. That's a wrong analysis. 240 is after bonus. 90 was acquired on 1st April 21. Bonus is given in November. So shares were acquired before bonus issue. So at the end of the year, the holding company will not be having 90,000 shares. They have also received bonus in the ratio of 3:5, remember. So their number of shares have also increased. What is important is the stake is not less than 50%. It is more than 50%. It actually comes to 60%. Minority interest will be 40%, remember. On 31st March, the inventory of S Limited included goods purchased for rupees 50,000 from H Limited, which made a profit of 25% on cost. 1/4 on cost is as good as 1/5 or 20% on sales. It's a downstream transaction. Holding company had sold the goods to subsidiary company because the goods are lying unsold in the closing stock of subsidiary company. Very simple. Stock reserve, 20% of 50,000, that is 10,000. Simple to effects. Less from the stock of S Limited subsidiary company and less from the P&L of holding company, because holding had sold the share stock. Holding had earned the profit. It is included in their P&L, remember. Details of trade payables and trade receivables are given. Breakup is given. What is bills payable, creditors, debtors and bills receivable. Prepare a consolidated balance sheet as on 31st March 22. What you have to understand is H company is having a 60% stake in S Limited. It was acquired on 1st April 21. So when you prepare a COC account, remember it will be for 60% stake. What I'll write over here is investments first. See the question. 1,500. Here what I'll write is by equity share capital. How much? 60% of 2,400. So 2,400 into 60% gives me 1,440. By pre-acquisition dividend. Subsidiary company has paid dividend on 14th July. 14th July is before the bonus date. Bonus date is November. So dividend will be paid only on the old capital. Old capital was 1500, remember. On that they have paid a dividend of 20%, that is 300, of which 60% will be received by the holding company, 180. 180 was taken to the P&L of holding company, which should actually go to your cost of control. So over here, by pre-acquisition dividend will be 180. How do I get this 180? It is 1500 of that 20% of that 60%, remember. Now if I prepare a P&L of S Limited, by balance brought down, very first 633,000 to dividend in bracket last year, it is 300. If I prepare a general reserve of S Limited, by balance brought down, see the first point, 1500 to bonus. Bonus was 600. What is the closing balance of reserve? General reserve. See, closing balance is 690. P&L closing balance is 810. So now what you're supposed to do is just analyze these figures one by one, remember. $900 is the bonus. Bonus was 900. This is by P&L, in P&L to general reserve 90, close by CYNP80. From where do we take this dividend? From this last year. Let's find out here. So this is profit is 567, remember. See, are we getting 567 profit? Now just analyze this particular P&L balance. Okay. Question is, this 90 is from where? Two choices. You select any one, your final goodwill or capital reserve remains the same. One is you can take it from this figure, and second is you can take it from this figure. It's or, remember. 90 will be taken, this is or. 90 can be taken out of the opening 633, or 90 can be taken out of the current year's profit of 567, remember. Choice is yours. It's just an analysis, remember. So if I'm taking 90 from 633, P&L closing balance is 810. Opening current year. Opening will be 633 minus 390. That's 243. So current year will be 567. This you divided into holding MI. This also goes between holding MI. 60, 40. So this is 145.8, which will go to my COC. 97.2. 567 into 60%. 340.2. This will go to the P&L of H Limited. And 226.8 goes to minority. So in my COC, I will write it as by P&L 145.8. Now general reserve. What will be the balance? 690, and this 690 will be considered as purely pre-remember. Sir, it includes current year's transfer of 90, but this 90 I've taken it from where? I've taken it from the opening balance of P&L, and opening P&L is pre. So transfer to general reserve is also pre. So this full 690 will be pre. Simply two parts. Holding MI. 690 into 60%. 414,276. This 414 will go to my cost of control. 414 by general reserve. If you check, now you'll get the goodwill or capital reserve. See, 679.8. Let's find out. 1440 plus 180 plus 145.8 plus 4 minus. This is my capital reserve. Capital reserve 679.8. They have done it in a tabular form, statement wise. We are doing it in account form. Answer will remain the same. It's just a matter of presentation, remember. So now based on that, this we have agreed. Minorities will be very simple to calculate, remember. This shareholding, 60% shares. We have already discussed that, remember. And then what you have to do is capital only of the holding. Minorities capital will not, subsidiaries capital will not appear. Reserves and surplus. Capital reserve, cost of control balancing figure. General reserve of holding company. General reserve, see 928, that is of holding company. P&L of H Limited, S Limited, less dividend and less unrealized profits, you get the balance. Unrealized profit will also be deducted from your inventory. See, unrealized profit has been deducted. Trade payables, you simply add no adjustments. Provisions, you simply add no adjustments, remember. Plant and machinery, you add, no adjustments. Furniture, you add, no adjustments. Inventories, yes, stock reserve we adjusted, but there is no adjustment in trade receivables, cash and cash equivalent, or short-term loans and advances. All those figures will remain the same. So you have the share capital, reserves and surplus. MI, you're going to prepare a note in which you will have share capital plus share in P&L plus share in general reserve only, remember. No more adjustments. So if I just prepare the minority interest also. How much stake? 40%. First, equity share capital. What was the capital of the company, subsidiary company? 2,400 into 40%. So that's 960. PNL, general reserve. We have prepared a working note at the top analysis. See PNL MI 97.2 plus 226.8, 324. And general reserve will be 276. Plus 276 plus 960, 1560. Minorities 1560. Trade payable short term provisions, you simply add. PP, you have to add. Inventories we saw, stock reserve minus trade receivable cash, this your balance sheet tallies at 10,233. We have done consolidation in a account format. They have done consolidation workings in a statement format. It's just a matter of presentation. Answer remains the same, remember. So with this, we complete the revision of RTP Advanced Accounts CA Inter November 22. Wish you all the best for your exams.